Something that you can go wrong with these days, it seems like, is having money in the market and watching the money in your retirement account go down. Certainly not a lot of fun. Market strategist Kenny Polcari tells Fox Business, don't panic. Just make sure that you're positioned properly.
It's not to the point where you have to light your hair on fire and say, I'm out because it's a disaster. I think you have to have a strong defensive portfolio to weather this storm.
So here's the question, Nolan. If you've already lost money, is it too late to be defensive, or do we just have to be patient and let the market bring us back?
Great question. I think there's some really good steps that investors can take right now with trying to be able to be in a position in this market, whether they want to be offensive or defensive. And in fact, when we recently did our economic summit, we had the players from the Toledo Walleye come out and join us. We did kind of a back and forth talking about, does offense or defense win games? And at the end of the day, you got to have a great defense, but you also have to have a good offense. Mm-hmm. I had a client that was in a couple of months ago, and, she's in retirement time, and she was just really kind of worried about, the downturn of the market, and kind of had felt over the next couple of years that things were probably going to be pretty choppy, pretty risky, and she wanted to take some steps to add some defense into the portfolio. So there are ways that can happen. I think one of the mistakes that people make is they oftentimes will wait until things go down when the market goes down, and then they'll just move to a cash or a position that gives them no opportunity to be able to rally when the market comes back. I think part of it is just a natural human emotion. First of all, you have to take into consideration your emotions when it comes to investing can get the best of you. Mm-hmm. I think a big part of it is people want to make a change because it's a desire to make a decision that they're taking control back, because we can't control short-term what the markets do. By making a change, I think sometimes it gives them the feeling of, being able to be back in control. But that can be a painful lesson because yes. If you look at like October, the month of October actually turned out to be a fairly decent month in the market. We got some good bounces. So you don't know short term, when things are going to turn around in a hurry. And if you get out when things go down and wait until things get better, that's effectively, selling low and buying high, which is a losing strategy. So here's some specifics for those of you that are listening that you want to add better defense into your plan, but being able to be in a position to participate if and when gains come back in the market. The first thing is a fixed index annuity is an option to consider. A fixed index annuity is an insurance product, and what in that particular case you're doing is you're buying insurance against loss of principal. That says if the market goes down, you're drawing a line in the sand. Yet if the market goes up, you're able to participate either in a certain percentage amount or up to a cap. That way, when the market recovers, you're able to go back up and participate in gains. The next strategy is what we would refer to as called protected equities. So protected equities are a strategy that we work with when you work with your custodian and you're thinking about your stock market type of an account. What a protected equity does is it will buffer a set amount of the decline in the market. So if the market goes down, say 20%, the investor could take a 5% decline, but be able to put the remaining 10% losses to another investor in that particular strategy using a protected outcome portfolio. In exchange for that, it usually has some type of capped outcome. Mm-hmm. When we look at protected equity strategies, what we're usually looking at is these type of strategies that are 1 year or less. So for those people that are thinking, we've got to get through elections, we've got to see how that pans out, we've got to get through some of this short-term stuff that's going, protected equities can be a really good strategy to take a look at. The third one is what is called hedged equity. And what hedged equity is again, a strategy where you're taking and a lion's share of the money is invested based upon the belief that the markets will go up over time, but hedging your position that allows you to be able to put losses at a predetermined point if and when the market goes down. So again, kind of giving you the best of both worlds. So the big mistake here is that people make is looking to go defensive, and by going defensive, they take their money out of something that's lost, aka stocks and bonds, and they go into a cash position just waiting until things get better, missing out on the recovery. So So there's ways to soften the blow, be more defensive, but yet be able to be in control of the outcome and be able to participate if and when the market goes up. So 3 things that if you're not talking with your financial professional about, talk about what fixed index annuities are, protected equities, and hedged equities, and understand the pros and cons and how that might help you achieve your outcomes a little bit better if you're concerned about where we're at in the market.
Again, as you mentioned earlier, it's all about control or the illusion of control. People wanting to, if things aren't going their way, wanting to do everything they can in their power to right the ship, whether or not it is the right move or the wrong move. I've used this analogy or this example before, but think back to March of 2020 when everything was shutting down and all the pandemic haircuts we saw out there. People just didn't know, when that was going to happen, and they thought, oh, I can do this and I'll be okay. I'll cut my own hair. It was a way to manage and also to kind of take control. Most of those didn't end up very well, but at least with those, if they were still staying at home, not really anybody got to see them. But when you do that with your retirement, if you take a haircut, an unnecessary haircut on your retirement portfolio, that is something that could take you years, if not longer, if at all possible, to overcome. So a better way to take control is to go ahead and put a plan in place ahead of time. And that is what the team at America's Retirement Headquarters will do for you. All you have to do to get started is give a call, 419-794-3030. Maybe your financial professional isn't talking to you right now about protected equities or fixed index annuities or hedge equities, things like that. The team at America's Retirement Headquarters, they can see if it is going to work for you, if it's going to be best for you, and then where to get started from there. But to get started, you give a call, 419-794-3030, or head up the website, americasretirementheadquarters.com.